When we say bettering ourselves, what do we mean? And what has this got to do with cryptocurrency investing? There is a critical first step of investing that can have catastrophic effects on your ability to succeed as an investor if ignored. Before we spend money on any investment in cryptocurrency, we first have to put in the groundwork and invest in ourselves in order to build the hardened, emotionless investor mindset needed to persevere in this market. To achieve this state of mind, we need a combination of studied and theoretical knowledge to really aid us with gaining the valuable lessons out of our real-life investment experiences. Essentially, this is like a mock exam prior to the real exam, where we prepare ourselves for intense studying to succeed in the real practical. Applying these practices through repetition and even just becoming informed on what is correct and what is not can assist in the time it takes to achieve a mentally focused state. The brain, when unconquered, becomes the biggest enemy not only to you but also to your account balance. If your psychological capability to handle impulse decisions and rationality in volatile markets is non-existent, it won't be long before your bank account falls to zero. This shift in mentality is needed regardless of what investment you make. However, the following most common enemies of progress are amplified 10 times over in cryptocurrency investing. To begin our journey in defeating these naturally occurring emotions, we must first identify them, break down their negative impacts on your long-term sustainability in the market, and finally, form practices to overcome them, aiming for our final goal of becoming conscious of when these emotions arise and being mentally equipped to come out on top every time they do. In no particular order, your biggest challenges will be greed, fear, denial, panic, depression, excitement, cockiness, and anxiety. As the cryptocurrency market is so volatile, you will feel a rush of these emotions as fast as the market goes from bullish to bearish, which coincidentally can change in a matter of days. The excitement, greed, cockiness, overwhelmed will very quickly diminish to delusion, anxiety, denial, fear, panic, and depression, and just as quickly go back to the good times again. The emotional turmoil is a completely new life experience for many, and many are not used to this, which means we must not only learn from this when we do experience it, but we also must be prepared to understand why this is happening and its effects on our logical thought processes. Greed. You will begin to experience greed after experiencing a good week or two in profit. You will at some point consider taking profit, but the gratification to feel larger profits will cloud your logical decision to actually bank some earnings. Fear. Usually the consequence of uninformed investing or investing more than you can afford to lose. Fear will strike you deep when you experience your first huge bear market or even intraday swing. Watching your holdings fall sometimes over 70% in a few days causes self-doubt. Denial. Denial will plague you when your investment decisions turn out to be incorrect. This will most likely occur when some extremely negative news is released or a scandal has been revealed. Your emotional attachment to the position will not allow you to understand your analysis was incorrect, leading you to hold a position until your capital is completely wiped, hoping it will one day return back to normal. Panic. You will feel panic during large intraday market swings, breakouts from counter trend lines in the opposite direction of your investment, and when negative news causes fear in the market. Again, this is mostly down to investing without doing the groundwork. Your thought processes forget the overall long-term bullish market, and instead your entire energy is focusing on a single candle that spikes down 30%, leading to panic selling in a loss. Depression. One of the worst consequences in investment, depression begins to creep up after a period of strong emotional distress. This can be a result of the above emotions taking their toll over time, or from suffering large losses and selling just before the market reverses back to your target. Excitement. This is a more positive feeling and should be embraced better than the negative emotions. However, excitement handled incorrectly will lead to the same results as being unable to manage fear and panic. During periods of good news or breakouts to the upside, as an example, it is easy to become overexcited and start entering more positions from the thrill of making more profit. A recipe for disaster when the market reverses and you're stuck deep in loss. Cockiness. Soon after excitement consumes you, the dreaded cockiness begins to show. After a series of wins, correct calls, and withdrawing some profits, it doesn't take long before you start to overbelieve in your abilities to time and milk the profits. Many traders and investors become consumed in the mindset of, this is easy, I can do this every time, until all rationality is gone in investment decisions and you're entering trades at all-time highs and illogical levels. A very quick way to empty your account to zero. How our mental state is prior to investing and opening our trading platforms will determine the effectiveness of our analysis and actions. We need calmness and clarity to work to our fullest potential. A simple exercise to achieve this state is meditation. Sometimes, no matter how much studying or research you do, nothing quite brings the results like the practical. Now that you are equipped with the knowledge of the emotional disadvantages that will come from emotional investing, you must program your mind through meditation. Following this simple plan for just 10 to 15 minutes daily, in the morning or before bed, over time aids in your ability to control your emotions and read the market's patterns in a crisp, almost spiritually powerful manner. Grab yourself a comfortable upright postured chair or cushion. Sit with your legs crossed, ideally in the pretzel, where your feet overlap. Make sure your surrounding is quiet and clear of distractions from other people. Should you not have a quiet place, simply grab some headphones and search YouTube for calming meditative music and frequencies. Make sure you have a very calming alarm set for 10 to 15 minutes. Close your eyes and begin to focus on your breathing. I recommend deep breathing purely from the nose. This is much easier for a beginner and effective for a returning meditator. Begin to gradually put all of your focus on the breathing going in and the breathing going out of your nose. Try counting to 10 if you are struggling to concentrate. This will not be easy in the beginning, but you will know when you begin to shift to a meditative state. After a while and the time is up, allow yourself to slowly come back to the present from the meditative state by the alarm you set prior. You will begin to feel clear, extremely focused and woken from within, ready to take on the charts. Write down in your course notepad how this affected your chart analysis compared to a normal state, and how you felt better physically from doing this. This will become a game changer in your investment journey once you apply these daily. A very fitting topic for the traits of the cryptocurrency market is a term you may have heard before, and that's the tortoise versus hare theory. Famously known from the principles of slow and steady wins the race, this lesson is also essential to be combined with the dollar cost averaging strategy. We are seeing a shift of newcomers coming to the market who are looking for immediate returns and instant riches, expecting endless rises of 1,000% week in and week out. Even worse, people with no investment experience being tricked into buying scam altcoins and ICOs. Even with no intention of actively trading cryptos, uninformed investors will be struck with fear from the volatility and start to lose all rational thinking, day trading their holdings as a result by swapping between coins frequently in an attempt to recoup losses. Which in reality, these losses are just minor falls, less than 10%, that usually last a week max. That is not investing. That's fear and greed leading to irrational buys and then praying for overnight millions. And before they know it, they have eaten into so much capital from selling at losses and buying at highs. We will refer to these investors as the hare, fast and uncoordinated. Ironically, if they had done the exact opposite and followed the principles of the tortoise, slow, patient and calculated, they would be in a much better position financially. Let's put this straight into a real life example and use two charts to understand this approach further. We'll start with the US stock index S&P 500, as it has proven to be a test against time for the patient investor, providing incredible returns for those who mastered the tortoise mindset. The chart dates all the way back to 1992 and extends to the present day. While I'm in no way suggesting the cryptocurrency market will replicate the exact growth of the chart, or that you should hold for decades, the cryptocurrency market is so young right now that the prices we are currently at are minuscule compared to the growth we could be experiencing over the next decade. Looking at the S&P 500 chart, we notice immediately after reaching all-time highs of $1,551 in 2000, over the next 3 years price crumbled over 50% to $770. It then took another 4 years to reach 1,550 region again, only to immediately melt over the next 2 years, even lower than the previous crash to $670. It comes with no surprise these crashes would have wiped many investors out the market from fear of either losing some of their already made profits, breaking even, or even making a loss. And if we zoom to a closer perspective as the crash was happening, before we started climbing higher again, you can see why. It looks like price would continue falling until it hit zero. The papers, media, and Wall Street were claiming it was the end of the stock market. It was overall a chaotic situation. This is the stage where paralysis hits you and clouds your judgment. You start to see it as rational to panic sell and cut your losses, to re-enter when the market reverses. The problem is, every time the market began reversing, it was only to create a new lower high and continue its downside fall. It's common to see this kind of behaviour in these market conditions. Yet, if we zoom out again, we see the fall in value was temporary. We regained all-time highs eventually, even breaching these levels to currently $2,500. Take note of the word temporary. Every directional swing in the market is temporary, and only the investments with real use cases will always continue progressing higher through these temporary cycles. It may have taken a few years, but that's exactly the investment approach we are taking with cryptos anyway. We want to sit through these drops, whether that's 20% or 80%, because in this current point in time, and in fact for the next 5 years, the market will reward the patient, emotionless investor in the years to come with huge percentage gains. Veteran investor and multi-billionaire Warren Buffett abides by these principles and praises them for his long-term success in the market. The Tortoise is all about longevity, and the Hare just wants a quick dollar. The profits you took from a panic sell could have been left to grow over 20 times its original amount, especially in cryptocurrency. Let's take this fresh outlook to a chart you will be analysing a lot. Shown is Bitcoin's huge collapse in 2013 after breaching all-time highs of $1,000 for the first time. I've purposely extended the chart to 2015, just before the reversal, so you can see exactly what investors would have been going through during this period of time. I can see 10 fake reversals on this chart timeframe alone, where investors would have sold in a huge loss, tried to buy on the reversal, and then had to sell again after the position fell even further in value. At the current Bitcoin price of $6,000, it's extremely interesting to see the people that have hundreds of millions of dollars right now are the investors that started purchasing since Bitcoin was less than $1 in 2010 and completely forgot about their investment over these years, or they continued buying regardless of price, whereas the day traders who are trying to analyse the market, every tiny move up and down, have barely a fraction of the long-term holders have now. This notorious video of an early adopter who sold all of his 30,000 Bitcoin at $300 during the downfall helps us see the impacts of selling because of temporary moves manipulated to shake us up. Whilst we cannot fault him for selling at a profit of $9 million, had he held on just 2 years more and rode the volatile waves, his 30,000 Bitcoin would now be worth $180 million. The Hare took home the quick profits. The Tortoise would have made exactly 20 times that amount just by sitting on his hands. Because Bitcoin hasn't been around as long as the S&P 500, we can zoom out and identify the price we're at now could be minimal compared to what it may be in a few years' time. As the S&P 500 chart and history has proven for all financial markets, Bitcoin is yet to have another huge crash, and just by understanding this, we can anticipate this due to happen in the future, and also for every other crypto at some point. We have to use initiative and be smart with this information. We do this by taking a small portion of profits and continuing to let the rest compound over time. Taking all profits off the table is fearful behaviour. Withdrawing slow amounts over extended periods of time is smart. If price falls, we can then reinvest with our profits ready on standby. This part of the strategy is covered in the profit-taking lesson, which will follow on from dollar cost averaging. These 4 lessons are combined to form the perfect buy, hold, profit-taking and reinvestment strategy.